Hello, I am Cem Oze. Welcome to the Weekly Market Notes program. This week, our agenda is quite busy. We will cover many topics, from the Fed-related uncertainty in global markets to the hidden danger posed by the record concentration risk in US indices. Of course, we will also take an in-depth look at the latest situation in commodity and digital asset markets, from critical levels in gold and silver to sharp declines in crypto assets. This week was a demonstration of how fragile the US markets, which have been oscillating at record levels, actually are. Investor psychology swung between the euphoria brought by the highs and the unease caused by underlying structural risks. The most shocking data of the week undoubtedly came from the US. 42% of the total market value of the S&P 500 index now consists of just 10 giant companies. This ratio has far surpassed the 29% level at the peak of the infamous dot-com bubble in 2000. This situation reveals how many passive investors, believing they are diversifying, are actually facing a significant systemic risk. Now, let's start with the global markets to examine the details of these two opposing poles. Global markets were at a crossroads this week. The main factors shaping investors' risk appetite, Fed policies, growth expectations, and geopolitical tensions continued to dominate the markets. However, this week, especially the mixed signals from the Fed clearly explained why investors are so cautious. On October 29th, the Fed cut interest rates as expected, bringing the range to 3.75%, 4%. However, this dovish move was overshadowed by hawkish comments from officials throughout the week. Markets received a clear message that there is no guarantee of an additional cut in December, and this particularly pressured momentum-driven sectors such as technology. On the growth front, while the IMF maintains its global growth forecast for 2025 at 3%, serious risks are accumulating behind this figure. US-China trade tensions have the potential to flare up again. High public debt levels in developed countries are creating financial vulnerabilities. And perhaps most importantly, due to the US government shutdown, we lack access to critical macroeconomic data. This data gap makes it nearly impossible for both investors and the Fed to predict the next steps. Looking at the data from a global macro signals perspective, Fed interest rate range 3.75%, 4% IMF 2025, growth forecast 3%, US mortgage rates decreased from 7% in January to a range of 6.1%, 6.3%, December 25th, basis point rate cut probability 66%. There is a point I want to emphasize here. When the markets do not receive a clear signal from the Fed, they essentially become a ship without a compass. The government being closed also darkens the picture. In this environment, it is not surprising that even the slightest negative news can cause major fluctuations. Let's now take a closer look at how this global picture is reflected in the S&P 500 index, which is the world's most important barometer. The S&P 500 is not just an index, it is also a barometer of global risk appetite. The movements we observed in the index this week indicated whether a rally at record levels is showing signs of fatigue and, more importantly, how structural risks beneath the surface are being revealed. Looking at the weekly performance, the S&P 500 closed the week with approximately a 1.6% decline. The index struggled to surpass the critical threshold of 6,750 points, and its inability to stay above this level was interpreted as a sign of a pause in the upward trend that began at the start of October. From a technical perspective, the index still maintains its medium-term positive structure by staying above the 50-day moving average. However, the most critical support level to watch in the short term is 6,600 points. If this level is breached, there is a risk of a pullback down to 6,150 points. But the real danger for the index, as I emphasized earlier, is excessive concentration. The fact that the top 10 companies make up 42% of the total index value poses a significant systemic risk for millions of investors seeking diversification. This means the index's fate is tied to the performance of a handful of mega-cap tech giants. Looking at the S&P 500 technical summary, weekly change, approximately 1.6%, return since the start of the year as of November 1st, approximately 16%, critical resistance, 6,750 points, main support, 6,600 points, Secondary support, 6,450 points. To gauge the pulse of the technology stocks, which are the main force behind this narrowing in the S&P 500, we are now turning our direction to Nasdaq. Nasdaq is not just a technology index, but also the momentum engine of the market. However, this week there was a significant stalling in this engine. The profit-taking observed in mega-cap technology stocks clearly indicated concerns spreading across the market, and investors beginning to question high valuations. Looking at the price movements, we see that the Nasdaq Composite Index broke its support at 23,100 points, dropping to 22,950, and closed the week with a sharp decline of approximately 2.8%. Similarly, the Nasdaq 100 index retreated from its peak of 26,300 points seen at the end of October. The most critical support zone technically is in the range of 25,500, 25,300 points due to the previous peak being broken and the principle of old resistance turning into support. In a risk scenario, if this support zone is broken, there is potential for the correction to deepen to levels of 24,650 and even down to 24,000. This is an important warning that the correction in technology stocks may not be over yet. My personal view is that the sales inflated by the artificial intelligence wave have suddenly come down with the Fed's wind stopping. The markets were pricing in perfection despite good earnings reports. Now is the time to face reality. Is this decline a correction or the end of the trend? Only the coming weeks will tell. To see how this flight from risk in the stock markets is reflected in the safe havens of investors, such as bonds and the dollar, we are changing our course. In this section, we bring together the three most fundamental indicators of global liquidity and risk perception: US bond yields, the strength of the dollar, and the euro's trend. These three are critical for understanding the direction of global capital flows and for catching clues about the Fed's next moves. Throughout the week, we saw investors fleeing from stocks and turning to safe havens in search of security. This led to the US 10-year bond yield retreating to the level of 4.093%. This decline indicates that the market is pricing in a stronger expectation of interest rate cuts next year. These expectations also directly affected the dollar index, DXY. Throughout the week, the dollar index was predominantly weak. According to sources, while the closing level varied between 99.55 and 103.8, the overall theme suggests that the Fed's dovish expectations caused the dollar to decline to its lowest levels in the past 3 weeks. Looking at the euro-dollar pair, we see that during the week, the pair broke the 1.1540 support level and tested the 1.15 level. But towards the end of the week, it recovered with the soft employment data from the US rising to around 1.1560. A move above the 1.1540 level could indicate potential for a move towards the 1.16 region. The dollar seems to be pricing in the Fed's dovish shift before anyone else. But is this weakness permanent, or is it just pre-storm silence? If the delayed US data comes in stronger than expected, we could see a sharp upward reaction in the DXY. What is the current situation in the commodity markets, especially gold and silver, which are usually supported by a weakening dollar? Let's take a look together. Commodity markets are the most sensitive asset class, reflecting the pulse of geopolitical risks, inflation expectations, and the dollar's trajectory. This week, we will examine whether gold and silver, after reaching record levels, are entering a consolidation phase and discuss new structural developments that could influence the future movement of these precious metals. Gold ounce, after an enormous rally during the year, has taken a more subdued course this week, closing at $3,999.60. Prices are consolidating within the range of $3,180 to $4,050. Technically, $3,180 serves as the main support, while a breakout above this level and a move to new highs require surpassing the resistance at $4,050. Gold's impressive return of 52.39% since the beginning of the year makes it one of the standout performers of the year. Silver is performing even better than gold, with an annual return of 66.76%. Silver, which stands out, managed to stay above the 48 level. The 50 psychological threshold is a critical resistance. Surpassing this level could push silver towards its historical highs in the 53.3 to 54 range. The most important long-term development for silver is the US adding it to the critical mineral list. This status structurally supports silver's industrial demand while also bringing new risks such as potential tariffs. Gold investors are holding their breath. Staying above $4,000 could signal an attempt at a new high. Silver is no longer just a precious metal, but also a strategic industrial raw material. This new status could change the rules of the game in favor of silver. Now, let's examine the reasons behind the sharp sell-offs this week in the cryptocurrency market, which is at the other end of risky assets and the critical levels. This week, the cryptocurrency market entered a sharp correction phase due to the combination of macroeconomic pressures and inherent risks. We will examine Bitcoin's struggle at the psychological threshold of $100,000 and the surprising developments in Ethereum and XRP. The leading cryptocurrency, Bitcoin, weakened the short-term bullish outlook by losing the critical support at $100,000 during the week. Technically, a daily close below $99,000 could pull the price down to the accumulation zone between $93,000 and $95,000. The significance of this zone comes from on-chain data, which shows that the $95,000 $96,000 range represents the average purchase cost for medium-term investors, thus serving as a strong support. For a bullish recovery, the initial target will be regaining the $106,000 $108,000 range. Despite this decline in Bitcoin, an interesting dynamic occurred in Ethereum. Ether broke the support at 3,400 and retreated to the level of 3,231. However, during this decline, on-chain data showed that institutional investors, or whales, were buying at the bottom. Major players accumulated approximately 394,682 ETH, worth about $1.37 billion, within the price range of $3,247–$3,415. This situation is interpreted as a positive divergence indicating long-term confidence. The star of the week was XRP, which resisted the overall market downturn. XRP not only maintained the support at $2.20, but also formed a technical bull flag pattern. Behind this resistance was an important news indicating institutional interest. A $500 million funding round led by Citadel and Fortress proved that XRP is seen not just as a token, but also as an institutional payment asset. Fear and greed have shifted again in the crypto market. Short-term investors are panic selling in Bitcoin, while major players are buying the dip in Ethereum. This is a classic market dynamic. XRP, on the other hand, is writing its own story, almost challenging the market. After this turbulent week in global markets, let's now take a look at the economic calendar to see the important economic data and events that could influence these markets next week. Next week's agenda serves as a roadmap for investors to adjust their positions and prepare for potential volatility. Data from international sources could be decisive in determining market direction. Internationally, the inflation data to be announced in China will be critical for global risk appetite. However, the main uncertainty lies with the US. The inflation CPI data, which should normally be released, may be delayed due to the government shutdown. If an agreement is reached during the week and the government reopens, the simultaneous release of all delayed data could create very high volatility in the markets. Therefore, investors need to be especially cautious of this risk. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week. I wish you a profitable week.